January 22, 1999. A Santa Clara chip company opens on the NASDAQ at $12 a share. 35 employees, most of whom took pay cuts to survive a near bankruptcy 3 years earlier, watch a stock worth about $73 million total, a rounding error next to Microsoft. Here's the number that matters. $1 put into that offering, never sold, would be worth close to $3,500 today. Not luck, one decision. Almost nobody noticed. That company was NVIDIA. The story people tell now, games, then AI, then the richest chipmaker on Earth, skips the part that explains the return. By the end of this, you'll know the exact signal that separated NVIDIA from a dozen graphics companies that went to zero. A signal visible years before Wall Street believed it. And you'll see that the signal isn't a one-time event. It's a pattern NVIDIA has run at least 3 times since, and it appears to be running again right now, largely unpriced. First, how close this company came to never existing. April 1993, a Denny's in San Jose. Jensen Huang, 30, a director at chipmaker LSI Logic, sits with 2 Sun Microsystems engineers, Chris Malachowski and Curtis Preem. Their bet? Computing's next wave isn't a faster general-purpose brain doing math in sequence. It's specialized chips doing thousands of calculations at once, the way an image is really thousands of tiny simultaneous problems. In 1993, that's not a serious idea. Intel owns the industry's identity, and what these 3 are describing is a chip for a niche institutional capital doesn't respect, making video games look better. Nearly every transformative technology enters the world looking like a toy. If it looked serious on day one, someone with more capital would already own it. They incorporate NVIDIA that year. Early products flop. By 1996, the company is weeks from insolvent, when a deal with Sega to build the Dreamcast's graphics chip goes wrong. The architecture NVIDIA bet on turns out to be the wrong one. Rather than just walk away, Sega's president pays NVIDIA $5 million to be released from finishing it. NVIDIA later called itself 30 days from death, more than once in this stretch. That money buys time to make one disciplined pivot. Abandon the proprietary architecture. Build for the emerging DirectX standard. Ship fast. The Riva 128 in 1997, then the Riva TNT in 1998, finally compete against a crowded field of rivals: 3DFX, S3, Matrox, most of them long forgotten now. In 1999, the same year as the IPO, NVIDIA ships the GeForce 256 and coins a new term for the category: the GPU. Nothing before that IPO suggested this company, out of 24 serious rivals, would be the one left standing. Most versions of this story jump straight from the GeForce to gaming dominance and money. But that wasn't the turning point. It was the payoff of surviving. The real turning point came 7 years later, in a boardroom, over a decision every analyst covering the stock at the time considered close to reckless. To see why it worked, you need to see how badly the market misjudged this company first. Through the early 2000s, NVIDIA won. It absorbed bankrupt rival 3DFX's assets in 2001, landed the graphics chip for Microsoft's original Xbox, grew revenue steadily. But Wall Street had already filed NVIDIA under one label: cyclical discretionary gaming hardware. The kind of stock you sell the moment a recession looks likely. Nobody modeled it against science. Inside NVIDIA's chips sat an odd, mostly unused capability. A GPU processes an image as thousands of tiny, independent calculations running in parallel. Jensen Huang and a young engineer named Ian Buck noticed that architecture, built purely for video games, was also well-suited to any problem breakable into thousands of small, simultaneous calculations. Weather modeling, protein folding, and, though almost nobody said it aloud yet, the math underneath a still obscure field called neural networks. In 2006, NVIDIA released CUDA, a platform letting developers write general-purpose software for GPUs. It cost a fortune for a market that was, at the time, essentially zero. Between 2006 and 2017, NVIDIA poured close to $12 billion into R&D, while revenue sat in the low single-digit billions. In 2014 alone, over 30% of revenue went to R&D. Shareholders complained. In 2013, activist firm Starboard Value took a stake and pushed to scale the spending back. Huang held the line. In 2008, the stock fell roughly 80% in the financial crisis. From 2007 to 2015, the company barely grew at all. The technology didn't need to be understood by the market to be correct. It needed to be correct. That gap is where the entire return was made. Most tellings walk you country by country, quarter by quarter, through NVIDIA's decade of expansion here. That's the section people click away from, so skip it. Instead, watch the actual shape of what happened. Because it isn't unique to NVIDIA, it's a repeating pattern. One NVIDIA has now run at least 3 times, and we're about to watch it happen for the second time, live inside the story. The shape. A boring, cash-generating business respectable capital ignores. Leadership funds a speculative bet off that cash for years, looking financially reckless. An external event, which the company doesn't cause and can't time, validates the bet. Then, the stampede. For NVIDIA, Stage 1 was gaming graphics, profitable, dismissed. Stage 2 was CUDA, $12 billion into a platform almost nobody used, funded by gaming profits. Stage 3 arrived in 2012. Graduate student Alex Krzyzewski, with Ilya Sutskever and advisor Jeffrey Hinton at Toronto, entered the ImageNet competition. Their neural network, AlexNet, crushed the field, trained on 2 ordinary NVIDIA gaming cards running CUDA. NVIDIA didn't cause AlexNet. It had simply spent a decade making sure that whenever a breakthrough arrived, its hardware would already be the tool in the researchers' hands. Stage 4, the stampede. Once deep learning proved out on NVIDIA hardware, every AI lab on Earth needed GPUs and CUDA, because CUDA was already the language the field's tools were written in. Dismissal, lone believer, external validation nobody could time, stampede. NVIDIA is running that exact play again right now in 2026, and almost nobody is treating it with the seriousness they eventually gave CUDA. Alongside its dominant AI data center business, it's quietly funding robotics and physical AI, a simulation platform called Omniverse, chips meant for humanoid and autonomous machines, years before a real market exists. It looks the way CUDA looked in 2006, an expensive hobby attached to a company already winning at something else. Whether it pays off is unknowable. Dismissing it purely because the market is small today was exactly the wrong instinct last time. Before the ascent, you need the cost. The version of this story that ends at "then AI happened" skips real job losses and a second near-death brush, 2 decades after the first. Not because the AI bet was wrong, but because of a different bet that briefly looked like easy money and wasn't. The same trick that makes GPUs good at neural networks makes them good at mining cryptocurrency. From 2017, miners bought gaming cards in bulk. Gamers couldn't find stock at retail price. NVIDIA's revenue and stock rose sharply. Then, in late 2018, crypto prices collapsed. Ethereum fell more than 80%, and miners dumped used cards onto the market, cannibalizing demand for NVIDIA's new inventory. The stock fell roughly in half in a few months. NVIDIA had to write down unsold chips and publicly admit it had misjudged how much of its growth was crypto versus durable demand. Even a company executing a decade-long bet correctly isn't immune to a shorter, faster mania sitting right next to it. The recovery wasn't gradual. In November 2022, OpenAI released ChatGPT, and every major tech company raced to train and deploy large language models built on tooling written for CUDA. Demand detonated. NVIDIA crossed $1 trillion valuation in June 2023, $2 trillion in February 2024, $3 trillion 4 months later, faster than any company had added a second trillion, and by mid-2025 became the first company ever to reach $4 trillion. 5 stock splits since 1999, the latest a 10-for-1 in June 2024, are the entire reason that original $1999 compounded into roughly 20 split-adjusted shares worth several $1,000s today. None of this makes NVIDIA invincible. In early 2026, the old skepticism has resurfaced in new form. Analysts question whether hyperscalers are overbuilding data centers. Amazon, Google, and Microsoft are building custom chips to cut dependence on NVIDIA, and export restrictions have shut it out of part of the Chinese market. 3 engineers at a Denny's, betting against how computing was supposed to work. A near death bailed out by a rival's mercy payment. A decade written off by Wall Street for funding software nobody used. a breakthrough it didn't cause, landing on hardware built just in case. A cryptomania that nearly derailed it a second time. Then, one moment, ChatGPT. That turned a decade of unprofitable conviction into the fastest accumulation of value markets have ever recorded. Here quotes the part you can actually use. The pattern never announces itself with a press release. It looks like a toy, video games in 1993, an indulgent software project in 2006. It only ever looks obvious in hindsight, once the stampede is already underway, which is the stage where the return is mostly already made. The people who did well out of NVIDIA weren't the ones who predicted AlexNet. Nobody predicted AlexNet, including NVIDIA. They were the ones who noticed a company willing to fund a decade of dismissed, unprofitable conviction out of a boring core business, regardless of which bet eventually paid off. Which is why the robotic spending inside NVIDIA right now deserves more attention than it's getting. Maybe it's nothing. CUDA looked like nothing for 10 years. That's not a prediction, it's a pattern. Now you know how to watch for it. If you want to see the next one of these coming, stay with me. The pattern's about to get clearer. None of this happens without the company that actually manufactures every one of these chips. A firm most people have never thought seriously about, and possibly the single largest point of risk underneath the whole AI economy. That's the next film. Same pattern, a different decade, still playing out today. That's the one to watch next.